I am joined by Michael Cow, former hedge fund manager and private family office investor. Michael, welcome back to Forward Guidance. How are you doing?
So excited to be back. Thanks for having me.
It's my pleasure, Michael. We're recording the afternoon of Tuesday, March 14th, and the regional bank stocks, which absolutely tanked in price, there were a lot of worries about bank runs and insolvencies. They have really found their footing today, and it seems like everything's going to be okay. So my first question for you is, what do you think of this bank panic, and do you think it's over?
Well, look, I think this BTFP facility, I tweeted out earlier, should not be confused with the BTFD signal, right? Because I think what it means is that it allows the powers that be to essentially seize irresponsible banks, right? And so to me, the facility is kind of like a controlled burn, if you will. They had to protect depositors to prevent the contagion from spreading. And just so you know where I stand on this thing, I mean, I think that if you are a depositor, and especially an uninsured depositor, you are an unsecured creditor to that bank, and so you should at least be doing a modicum of due diligence on the bank, especially if you're going to be parking hundreds of millions of dollars of cash there. And so clearly that did not happen, and I don't like the fact that there is moral hazard by not haircutting the depositors at all here. But if there's anything that I think all of the authorities learned from the great financial crisis, it is the danger of having inconsistent policy. So what I mean by that is, if you remember, like about a week before Lehman Brothers failed, Fannie and Freddie were seized and put into conservatorship. Total surprise to them, right? You could argue, and I would argue, that that didn't need to happen. But then there was also sort of unilateral decisions made within that capital stack that were inconsistent. You had obviously Lehman go, and they seized WAMU, but they chose to save Countrywide right before they shut WAMU down, and then right after that they saved Wachovia. So it was a complete haphazard policy that, and look, all of that was an unprecedented situation, obviously, very, very different from what we have now. So I think over the weekend I was tweeting that even before this BTFP facility came out, I said that my expectation would be some kind of surgical solution, but not involve a shotgun or a bazooka solution that entailed a change in policy stance. And so to me, I'm personally quite surprised at the big risk on, especially like in Bitcoin and tech stocks and whatnot. I'm not surprised in like the relief rally of the banking sector, because that's frankly the only equity sector that really experienced true distress. But the rest of the stuff is just symptomatic to me of a regime that is still awash with too much liquidity. And I'm sure we'll talk about the CPI. I mean, look, the CPI this morning is definitely still running on the hotter side. And it's not as if it's a one-off, right? We've had very strong employment reports. So I really think, going back to BTFP not being BTFD, I don't think this risk rally is real. I don't think it has legs. I think that people will be surprised that the Fed is going to not wilt as many asset classes seem to be pricing in, right? I mean, I'm very, very surprised by. I expected the yield curve to kind of breathe a little bit after this incredible flight to safety to T-bills, especially, right, over the last couple of days. I think there's probably still a little bit of angst that's keeping the yield curve that way. So I'm watching that carefully as some sort of corroboration that things are indeed sort of ring-fenced and calming down. But I don't think the easing path that the yield curve is currently pricing in is going to hold.
Michael, that's great. I want to ask you about what do you think the Federal Reserve is going to do and the yield curve dynamics you just referenced. But real quick, based on your prior comment, and correct me if I'm wrong, it sounds like you would give the response that the FDIC, Federal Reserve, Treasury announced on Sunday. On a moral hazard basis, you'd give it maybe a C as a grade. What would you give it the grade for financial stability? In other words, how effective will this be in preventing future bank panics? And do you think future bank runs will be likely, unlikely in the near future?
Well, from that perspective, I would give it an A, because I do think that again, back to my my comment about the importance of consistency. As repugnant as I and many find that there was a bailout of depositors here, I understand why they had to do it, because see, bank runs are the fractional reserve banking system is one that is based on trust, and 99.99% of the time it works really, really well, right? But the problem is that when you have mass hysteria, especially now really, really amplified by social media in an unprecedented way, it can really spread like wildfire, and it can metastasize into something bad, even with responsible banks. We saw that during GFC. Now, it's never possible to prove a counterfactual, but in this case, I even think that even if they actually had haircut depositors, I still don't think this was a systemic issue. You probably would have had a couple of bank failures, a couple more bank failures, but I still don't think this was systemic. But given what they did, I think the banking scare is done. Now, what else lurks underneath is the question, right? And I think you're going to see some real problems in the shadow banking sector, right? Well, as far as hedge funds, as far as private equity, venture capital funds, endowments, even, right? So I definitely think there's going to be more stress. So I just can't emphasize enough that this is not, BTFP is not BTFD.
Right. And BTFP is the Fed's program announced on Sunday, Bank Term Funding Program, which allows banks to pledge assets as collateral to the Fed, and the Fed will give them 100 cents on the dollar. It's a term loan up to 1 year. So giving the banks a lot of breathing room. And BTFD, of course, stands for, by the blank dip.
But it's important. It's important to note that, like, the BTFP facility, it's not like it's a complete free lunch. It comes at a cost. And I'm going to paraphrase Fed guy Joseph Wang on this, right? On a space that he said a couple of months ago. He said, the Federal Reserve, but I'll expand it to all of the various agencies and the powers that be. They have now more surgical tools to provide liquidity at a price. But that price might be that your bank gets resolved, right? And so that's not it's not a free lunch. Certainly not for investors. I kind of think I love Greek mythology, right? So it's kind of like if you partake of the pomegranate seed, you might not make it out of Hades again.
Yeah. I like that. Tell us about the shadow banking sector. What are the risks you see there? And might it be possible to draw a connection to the actual banking sector, because the shadow banking sector and the actual banking sector are very connected, as we saw with Silicon Valley Bank?
Well, it's just that the shadow banking sector, that really covers a broad swath of all, financial intermediaries, right? From hedge funds to private equity to venture capital to endowments. And obviously they're not held to as stringent standards as the banking sector, and certainly are not subject to FDIC or SIPC insurance, right? Every financial blow up in history happens for one reason, asset liability mismatch. That's almost always the case, right? Unless it's fraud, outright fraud, right? But even outright fraud situations, right? Usually they're perpetuated until that asset, there's a forcing function on a fundamental asset liability mismatch, right? And so I think over the weekend, there was a lot of FUD and angst over Schwab, for instance, right? And everybody talking about how, they've got these big, held to maturity losses, blah, blah, blah. But you know what? When interest rates rise, everybody who has fixed income securities, or for that matter, any securities, are going to have held to maturity losses. But again, what's the forcing function for that asset liability mismatch? The forcing function is a bank run. Now, when Schwab Bank has, over 80% of its customer deposits FDIC insured versus a Silicon Valley bank where that equivalent number was less than 3%, that's a huge difference. That's just a massive, massive difference. So I see the two as completely like night and day. It was I think the failure at Silicon Valley Bank was mismanagement on both the asset side and on the liability side of its balance sheet. And so back to your question on the shadow banks, who knows, right? I mean, we saw a snapshot of Bill Huang. Remember, how long was that ago? Was that almost 2 years ago?
2 years. Yeah.
Yeah. Well, I think there's going to be more of that coming. It's kind of inevitable with this type of a steep rate hike. But again, so then why do I think that the Fed won't pivot? Because at the end of the day, the big picture thesis that I've had over the last 1.5 to 2 years now is that we are in a fundamentally different regime than we've experienced over the last several decades, where there is a structural inflation that is not going to be tamped down very easily. And so what I was explaining yesterday in one of the spaces that I participated in is, okay, so let's take the oil industry, right? There is a structural supply inelasticity, I'll just say, right? Structural supply inelasticity that will not be fixed with monetary policy, right? It can only be fixed through long-term industrial policy and investment, right? So while it's true that monetary policy is a blunt tool and can't solve everything, when it's all you got, and you've got supply inelasticities built up in multiple sectors, the only tool that you have is monetary policy to basically shift down the aggregate demand curve, and to not let it bleed into other sectors. I think that where the Fed really screwed up was, look, you could argue that the unprecedented stimulus was needed in 2020 to not tip the world into recession, but we clearly overdid it in 2021, right? And they let the Pandora's box stay open for way too long. To me, this inflation started off as a commodity-based inflation, and it basically leapt into many other sectors. And now it's going to be very, very difficult to shut that Pandora's box.
So connect this for me, Michael. On Monday, Silicon Valley Bank was taken over by the Federal Deposit Insurance Corporation. Treasury yields collapsed. There was a huge bid to safety. The same thing happened on Monday as the Signature Bank takeover was announced on Sunday. So on Friday and Monday, the past two trading days, I think the 2-year Treasury rallied close to 100 basis points. I think that's the biggest Treasury rally since 1982. A huge rush to safety for long-term securities as well as short-term. You had a bull steepening, which is never a good sign for the economy. And so people saying, "Oh, the market was pricing in the Fed is done." Maybe.
And by the way, that rate fall might have blown somebody up. That we don't know about yet.
Yeah. And the irony is rates collapsing would have actually done a lot to help Silicon Valley Bank.
Exactly. Yeah. Right.
Right. So the market went in from pricing a 50 basis point increase in the Federal Reserve meeting next week in 8 days to they're not even going to do 25. Now it seems rates have gone up a little bit. And so there seems to be the market was indicating the Federal Reserve had to choose between financial stability, the banking system will be safe, or price stability. If you want to save the banking system, again, I'm intentionally making it it's very simple. You have to stop rate hikes and perhaps even cut rates. But there goes your fight to fight inflation. Meanwhile, if you want to go on the inflation front, if you keep on hiking interest rates, there are going to be more Silicon Valley banks. Is this a trade-off that you think the Fed has to actually make? And if so, which will it choose?
I don't think the trade-off is here. In fact, this morning I tweeted exactly to this point, and this is exactly what I said. I said, many think we've reached the point where the Fed is facing a real trade-off between hiking versus not hiking / easing. The surgical nature of this BTFP just eliminated that trade-off, and the hot CPI just ensured no pivot, in my opinion. So I think, look, there will be a trade-off. I think the trade-off comes later this year when unemployment starts to finally tick up. But let's just put this into perspective, right? I think Jay Powell would like to see the unemployment rate. I think he'd be perfectly okay with a 4.5% unemployment rate. That's not a loss of 20,000 jobs or 200,000. That's probably 2 million jobs, right? So for all of the belly aching by the startup community and the venture capital community saying this is going to create massive job losses, guess what? The Fed wants to engineer that because unfortunately, and I don't want to sound callous about this, but this is where the needs of the many outweigh the needs of the few, right? And what I mean by that is inflation is the most regressive tax of all. It affects 100% of the population, which is what, 340 million people, right? But and what the Fed is thinking about, I'm sure, is, okay, well, you know what? What's going to happen if we have 2 million more unemployed, right? Are the other 338 million people better off? And I would argue the experience of the stagflationary 70s would probably argue yes.
So you've been sounding the alarm bell about structural inflation for a while now. I've seen an argument that's become a little more popular over the past few days, which is that the bank panic that started on Friday is causing a scramble for reserves, a scramble for assets, for deposits at banks. And they're going to do everything they can to make sure depositors don't pull their money. As such, they will be less likely to lend money because they're going to be holding on to their cash, and bank credit creation fuels a lot of inflation. So that will slow down the economy and reduce inflation. And we did see that in the wake of the great financial crisis. Even though rates were at zero, bank lending was very slow to accelerate. Do you buy this argument?
Yeah, for sure. So I mean, yeah, I buy the argument that there are long and variable lags, and I even buy the argument that there's even a case for the Fed maybe pausing and watching. But I do think, again, given my sort of commodity centricity, I think that there's a big component of this inflation that is not going to be easily tamped down, even with all of that, right? And so the issue that I have is I could buy into the issue that maybe they need to pause and just wait and see what happens, right? But I have a feeling that unless they significantly move the goalposts in terms of what the inflation target really should be, they're not going to be in a position where they can ease this time. There was a great chart that Cameron Dawson posted in the space yesterday that I retweeted that basically showed the core PCE over the since like the the early 90s to now, And so that chart basically just shows that, it was basically in like this tiny, tightly bound range, and then boom, right? And so, and that's the thesis that I've had now for almost 2 years now, is that structural inflation changes everything. It does not. Everybody thought 2 years ago, if you remember, there were many voices who said that, oh, given how much debt we have, debt to GDP is going to explode, and the Fed can never hike, blah blah blah. Well, here
never, Michael. They're never getting to 50 basis points. Never.
Exactly. But see, again, I mean, I write about the dollar, and I think that, what, we have the capacity. It's going to suck for a while, but we have the capacity. Yes, it will increase our deficit, but we still have that capacity to increase that deficit until we get this situation under control.
Hey there, sorry to interrupt. A lot of Forward Guidance listeners are not into crypto. If that's you, please skip ahead, get back to the interview. Some Forward Guidance listeners are into crypto. Some own crypto. A smaller percentage owning lots of crypto, and a much smaller percentage work at crypto hedge funds. If you're in those latter two categories, Blockworks Research might be a good fit for you. Blockworks Research is a research and data platform that analyzes governance, tokenomics, and models of interesting crypto projects, including new protocols. There's a lot of edge that can be gained from reading these reports. You can check out a sample report at www.blockworksresearch.com/research and hit the free report toggle. If that is of interest, full subscriptions can be purchased at www.blockworksresearch.com/sign-up. You can also get 10% off using the discount code guidance10. Thanks, and let's get back to the interview. Your background is, many things, from convertible bond arbitrage, hedge fund, but you know a lot about commodities. So commodities, key input into inflation. So let me ask you, let's just say, make it really simple. In year one, the price of oil is at $70. In year two, you have an oil spike. It goes to $140, and it stays at $140 by year three. The year over year change from year 1 to 2 will be 100%, but from year 2 to 3, it will be 0%, even though 140 is high. And so oil prices, not only have they not continued to not increase, but they've actually they've gone down since the peak of the summer of last year. So if you're not having these inflationary pressures from oil, where is it coming from? And of course, we're recording this on a day, and it's a testament to how much is going on that it's only 20 minutes in. I haven't talked about it, but at 8:30 this morning, consumer price inflation came in at 6% year over year for February, 0.4% month over month from January to February. And if you take out energy, it was 0.5% month over month and 5.5% year over year.
Yeah, so that's a great question and a valid one. I think that right in the short term, and if for those of you who followed my tweets over the last year, probably around April of 2022, even though I'm long-term bullish on oil, I think that I basically said, you know what, it's too hard to call now. I'm going to turn cautious and even outright bearish, because there's I think the negative feedback loops of a stronger dollar and global central bank tightening have got to feed into that demand. But I've also said that I think the seeds have been sown for a point sometime within this decade. I think we're getting, in fact, it's going to be that's even a little too far out. I think that around 2024, 2025, we're going to come perilously close to what I call the supply demand singularity point, where even a sort of recession impacted global demand is going to exceed all available supply. So when you look at the US, for instance, right, the US produces about 12.5 million barrels per day. About 9 million of that comes from shale, right? And most people know that the Permian Basin is the most prolific and promising part of the shale patch. The Permian, Lakshmi Srikumar, who's the Capital One analyst that I cite a lot on Twitter, I think she's one of the best in the industry. She thinks that the Permian shale in general, so U.S. production is likely to see a short-term peak but in 2024. So imagine the scenario. Let's just imagine the scenario where Jay Powell follows the yield curve and actually blinks and starts easing by the end of this year. Okay. right when we peak production, what do you think will happen? I think that will literally bring us back to where we were at the beginning of 2021. Rinse and repeat. It starts all over again. And then when the world is subjected to a second round of resurgent high inflation, and by the way, this time around, because we've done some very, very stupid things, like transfer the bulk of our SPR over to China, basically, right? This time, that oil spike might not be to 140. It might be to 250, 300. So it's a to me, that's a, I don't know whether you want to call it a black swan or a gray rhino or
Yeah, Michael, that means a lot to me because you are not an oil permeable, even though you've been very, very, very involved in the industry. You've always cautious been, yes, I'm long-term bullish, but I don't quite see this setup here. So that means a lot to me. Michael, paint me a picture of what.
And by the way, yeah. Jack, to that point, I'm talking against my book, right?
Yeah.
I mentioned this at West Point when I presented my paper, right? I basically said, I just want everybody to know that, yes, I am a long-term investor in the oil and gas industry. However, the industrial policies that I'm promulgating to invest in the industry will result in lower commodity prices. I'm talking against my book here, both from a policy recommendation standpoint, but also from a market call standpoint, because I think unemployment spiking, if unemployment does start to spike, I can't see that as bullish in the very near term for oil. But again, against this longer term backdrop, I see a major global, it's not just the US, but it's like a global dearth of long-term projects. See, it's interesting because at West Point, I met a bunch of smart people. I was pretty intrigued that there were some smart but misinformed voices that I interacted with who still thought that we would easily achieve 15 million barrels per day. Pre-COVID, the US hit 13 million barrels per day for about a nanosecond. That was when Trump was proclaiming energy independence, right? And I think I put out a tweet back then. I said, "Here's what I predict." I think there was a chart of like our energy, our level of independence expressed by our I think net exports or something like that. And I said, I predict that this is going to be basically the nadir of this independence, the so-called energy independence. And here we are multiple years later, and we haven't even crested that 13 million barrels per day. Because the shale industry, as you probably know, it's kind of like a hamster wheel, right? You need to run really hard on that hamster wheel just to replace, just to keep up with the decline. And that really hasn't happened, right? And so the U.S. shale miracle came about as a result of a number of different factors that are, I think, not going to coalesce together again anytime soon. Those factors are, well, first of all, just, obviously the technology that went into it, but there was also tons and tons of capital available, right? The liquidity lottery benefited the shale revolution, absolutely. Okay, but it's also because the U.S. has a system, an economic system, where it allows private ownership of mineral rights. So there is that incentive. So we're not alone in the world with shale deposits. There, if you look at Argentina, the Vaca Muerta has big shale deposits, but why haven't they been like a big player? Because it's a freaking socialist country and there's lack of infrastructure, offtake infrastructure, right? You need a lot of water infrastructure also. So
and sand.
So it literally required a sort of perfect storm of factors to get that to happen. But we're about to crest that. We're about to reach that peak. And so, excuse me, what's going to plug that hole? The world is awash in fossil fuel reserves. So there's no lack of oil, but there's a lack of cheap oil. I really believe that. And so unless oil is significantly higher, I think we are, I use the term frog boiling. Our ESG policies are basically like boiling the proverbial frog in the pot, right? And we're frog boiling ourselves into an energy crisis. And again, I focus on energy so much because it is the linchpin of inflation.
And so that's the supply picture. Talk to me about demand. I'm a young guy, so while I was an adult, the major financial crises were 2008 and 2020. But it's and during those recessions, flash recessions, the price of oil absolutely collapsed. So maybe that's my impression. But what does a more, quote, vanilla recession look like? And if we are, might be approaching a vanilla recession, why might the demand not go down enough for the price of oil to decline? And you said the price of oil might even go up during a recession. Tell me about that. And maybe you can draw on recessions before 2008.
I'm actually a little bit surprised that the oil prices have held up as well as they have. And let's see, what are they doing today? I don't even know.
Down then up.
Are they okay? Got it. I think there's a component of geopolitical risk premium that's still embedded in there. Many thought that the great China reopening would create this hyperbolic move in oil. And I, along with, you probably know Alex.
He's
Stock.
Fantastic. Yeah.
Yeah, he's great. We've both been on the same page on this, and we've basically said that China, what is China going to reopen to exactly when their product inventories are already at tank tops? I've been saying for also about a year and a half, I've been saying that the Russian oil, you're not going to basically shut off the Russian oil spigot with price caps and embargoes. The only way to shut off the Russian oil spigot is blockades, and we all know where that leads, right? So that hasn't happened. So Russia has not shut in. And Alex and I had this conversation a couple of months ago about, on the eve of when the EU embargoes were about to happen, and then in February you had the EU product embargoes, and the thought was, look, unless China really steps up its SPR purchases, it seems like they're kind of tapped out, and India also seems like they're kind of tapped out. So there was a reason, there was a cogent thesis for maybe Russia having to shut in 1 to maybe even 2 million barrels per day. Didn't happen. It didn't happen. And so you kind of wonder, how has this happened? Well, remember, China's SPR capacity is now bigger than ours. And they have.
Sorry, Michael, that's a strategic petroleum reserve, a nation's reserve, and America had been selling it down since May, June of last year under the Biden administration. But you're saying China has been building it up.
They have, but even with all of the stockpiling, they still have a fairly significant amount of capacity, right? So I've said all along, look, the Chinese have definitely taken advantage of that. And it's very frustrating for me to watch that. One of the things that we mentioned this in our West Point paper as well, right? Said that basically, the we did some comparisons between the semiconductor industry and the oil and gas industry, and noted that, while the administration seems to be taking appropriate steps, for instance, in incentivizing the reshoring of semiconductor fabrication, for instance, and I'm even supportive of some of the targeted export controls that we've done to limit their ability to continue to advance in advanced chips. But that's great. We finally recognized the threat in the semiconductor industry. But why on earth are we still shooting ourselves in the foot in the oil and gas industry? Because that's an area where we're currently the largest producer in the world. We're producing 12.5 barrels per day when Saudi Arabia and Russia are each producing right around 11 million barrels per day. So we're actually the largest producer. This is an area where we have a very, very strong natural advantage, but we are kind of hobbling ourselves by gutting our SPR, by disincentivizing investment, by shutting down.
How so are we disincentivizing?
Well, for instance, if you threaten windfall profit taxes and you threaten export bans, right, and you shut down Keystone, what is that saying? You're telling all of the majors that we're going to shut your business down in 10 years. But, oh, by the way, can you please increase production? Mm-hmm. Right. So like, what do you expect the industry to do, right? From a capital allocation standpoint, are they going to, there's all this criticism about, their redeployment of the cash into share buybacks. Well, they're being told that their industry is going to be shut down in 10 years. So why, right? If you're being told that by policymakers, right? And your choice is to either essentially run a policy that shrinks the company, right, by essentially buying back your own capital versus expending tens of billions of dollars in capex. What are you going to choose to do? I mean, that doesn't seem like it's rocket science to me. So, and by the way, that's not just a U.S. phenomenon. That's a global phenomenon.
Going back to oil demand, earlier you said that you were surprised that the price of oil isn't down more given how you're seeing the economy, the supply situation. So why is it that you see the price reaccelerating? And then also, can you talk about how the U.S. is a consumptive society, whereas China, a lot of their oil demand they use to produce distillates. So they're not. It's not a ton of jet fuel just because the Chinese economy is reopening, and the refineries were running at full capacity all throughout COVID.
So it comes back to what I was talking about earlier in terms of supply inelasticity. I see the longer term supply curve for oil becoming more and more inelastic. So what happens when you have an inelastic supply curve? It means that it means that it's very, very sensitive to shifts in the demand curve, right? So if you've got like a near vertical supply curve and you've got like a downward shift in the demand curve because of, say, global recession, you could have that price of oil just plummet to $40-50 even, right? Unless OPEC supports the price, right? But again, similarly, when the world comes out of that recession, and meanwhile the industry is even more starved of capital, and that inelastic supply curve gets more and more vertical, then you could have a very, very parabolic price spike. And now with a kind of a lack of a hedge now, right? Well, I should say this. Look, China, in a way, China may keep a lid on a parabolic price spike. It may, because they have built up this big SPR. But then again, right? Their SPR is not even necessarily that big relative to their population size. So, so it's a hard, demand is always, supply is much easier to analyze than demand, always. It's much, much harder to figure out, for instance, what true demand elasticity is. Because like the demand elasticity in oil tends to be very inelastic in the short term, but longer term elastic, right? Because if you see a price spike in your earlier scenario of like 150 just persist and stay there, right? You will see behaviors. You will see behaviors change. You will see, you know, mass carpooling. You'll see, like, you know, emerging markets, you know, economies, going to little Vespas and scooters and things like that, right? And you might even see some, you know, those types of behaviors happen here, right? Versus, you know, our SUV culture. But again, that's what I mean by longer term elastic. But in the short term, meaning like say 6 to 12 months, shit. You need to drive. You need to, whatever mode of transportation you have, you're stuck with it, and you're going to pay whatever price is necessary to get to work or get to wherever you need to go.
Right. So let's tie this together. Inflation will continue to be high. If you're right about oil, that will contribute to inflation as well. If inflation is high, the Federal Reserve will continue to tighten monetary policy. If their backstop on the banking system is airtight, how high do you think the Federal Reserve gets? A week ago, the market thought they could get to 5.5%, which would be 3 more hikes from now. Now it's thinking it can only do 1 more hike. What do you think? Do you have a view in this? And then also, I've seen you say that you think other central banks around the world will be first to blink before the Fed. The Fed will be last to pivot. Why do you think that?
I think that because, again, when you look at the relative strength of the U.S. economy, again, going back to comparing this to, say, like a GFC type situation, this is not that. We are so far from that period. We still have like 3.5% unemployment, and the last several employment numbers and PCE prints have actually been reaccelerating to the upside. I don't expect that to last, but the point is that the economy still has a head of steam to it. Now you compare and contrast that to, say, UK, right? UK the Bank of England is in a real bind because they're experiencing double-digit inflation still, but their GDP is already close to the zero bound. So what are you going to do? Right. And then when you come to the big elephant in the room, the big post that I released last weekend on my Substack that's pinned on my Twitter right now is, I call it a ball in a china shop, specifically the US dollar wrecking ball. I think, look, as I prefaced that blog post, I said, I actually called this Silicon Valley Bank situation kind of a provincial crisis, and I honestly think that this BTFP facility has basically ring fenced that. I think the real ticking time bomb for the global financial system is China, because China's hidden debt. So all the anti-dollar people like to point out, look, look at China's pristine central balance sheet compared to the US's and the rest of the developed world, blah, 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 blah. Except all of it's a facade, because this China's banking system is so opaque and obfuscatory, right, that all of their debt is basically off balance sheet, off the central bank's balance sheet. It's basically between the state-owned enterprises, property developers, and these LGFVs. What is it? I can't remember what it stands for. But I mean, to me, it's it literally is a page out of the Enron playbook, except writ large, writ super, super large. And so when you combine all that together, it's actually the most levered economy. I cite in my blog post, I cite this interesting work that this guy Andrew Hunt did I had to listen to his podcast like 3 times to understand the import. But he basically had his team basically hire a bunch of, like Chinese translators and basically scrub annual reports of like 36 of the largest banks in China. And he thinks that there's a $4 trillion with a T, $4 trillion gap between what China says is in their sort of balance of payments versus what's actually there. And so when you look at when you ponder that, right, China is in a really, really tough spot vis-a-vis all of the world central banks, because look, despite all of their efforts to kind of jumpstart a true domestic consumer driven economy, they're still very much dependent on exports, right? Specifically exports to the West. Now, if the West is on this huge hiking policy, trying to slow down their economies, what's going to happen there, right? So China needs to really devalue the yuan to try to make their exports more attractive, right? And they also need to they need to do it to revive their moribund economy, but they also need to do it potentially to raise capital to pay off their dollar-denominated debts.
Hey there, sorry to interrupt. Announcement. Blockworks is hosting an event called Permissionless in September. It's a crypto event. It's in Austin, Texas. We did Permissionless in 2022. It was the biggest and best DeFi event in the world. And this year, Lightning will be striking twice. Historically, our ticket prices have gone up about 10 times from the day the tickets go live to the day before the event. If you're like me and bad at math, that's 900%. So it might be savvy for attendees to consider buying tickets now rather than later. If you're listening to this and you're saying, hey, Jack, I'm not really into this whole crypto thing. I want to hear about the Fed. I want to hear about the dollar, Bretton Woods 3, 4, 5. I hear you. I'm not telling you to buy a ticket, and the interview will resume momentarily. However, if you are into the crypto thing and Permissionless is something you might want to attend, what I'm saying is there's no time like the present, because tickets will go up, and if history is any guide, prices will go up a ton. Anyway, the link is in the description, and you can get an additional 10% off by using code GUIDANCE10. Thanks. Let's get back to the interview. Michael, so the dollar-denominated debts in many emerging market economies, if they want to borrow in their local currency, they have to pay 10%, 20%, but they can borrow in dollars and only pay 3%. The only problem is they're on the hook for currency risk. So if their own local currency weakens drastically relative to the dollar, which has happened frequently throughout history, then they have a problem. So that's happened in many emerging markets. Yeah. There's a chart that I've seen that shows that actual China's dollar-denominated loans is actually very, very low. Are you saying that chart is incorrect because there's lots of hidden stuff?
That's exactly what I'm saying. And I'm paraphrasing. So there were a bunch of resources that I cited in my blog post. The Andrew Hunt interview, a couple of other papers, but basically saying exactly that. That not only do you have a duration mismatch, you've got a currency mismatch, and then the underlying collateral is primarily these insolvent property developers, and even just insolvent sort of one belt one road projects like that ill-fated port in Sri Lanka, Hambantota. So lots and lots of problems. So and as you say, right, so the PBOC, I put out this graphic in that post. I love, again, Greek mythology, Scylla and Charybdis, right? I basically said, look, Odysseus and that ship going through that narrow strait between the Scylla and Charybdis, that's the PBOC right now. On the one side is you've got the Scylla of a weaker yuan, right? So if you have a weaker yuan, you have that problem, exactly that problem that we just talked about. But you also import commodity inflation, because again, most commodities in the world, especially oil, are U.S. dollar denominated, right? So if you have a if you experience a 1-2 punch where the price of the commodity experiences some sort of shock, which I think is coming, and you have a strong dollar as a result of our domestic fight against inflation, and also as a result of other central banks' inability to keep up with the Fed, then you've got a double whammy, right? So that's the Scylla. The Charybdis is, well, what happens if they have too strong of a currency? If they have too strong of a currency, they really screwed up with basically the Evergrande situation and then the zero COVID policy. They basically gutted their domestic economy, and they're flogging a dead horse, I like to call it, by trying to stimulate like crazy. And so you saw the yuan strengthen a little bit, I think last month, when in I think January there were these Chinese PMI numbers that showed huge rebound, blah 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 blah. Well, again, as Lakshmi correctly points out from Capital One, she goes, the PMI index is a diffusion index. It's a measure of breadth and not depth. But then the other thing is that
just explain that. So something above 50, 52 indicates growth. Something below 50 indicates contraction. But if you're starting from an absurdly low base, then anything that's a 51 means you went from very horrible to slightly less bad.
So it looks like this unbelievable recovery, right? But then when you put it into perspective, I think that the total amount of stimulus was something like 6 trillion yuan of stimulus. And look at where oil is. Where's the Chinese reopening? So if
right, but Michael, as you and Alexander have pointed out, the Chinese reopening can be robust and the price of oil not go up a lot, because unlike in the US, fuel demand, jet fuel demand is only like 3 or 4%, and this is numbers I got on Twitter from you and from Alexander. And driving demand, it's all about those refineries that are producing products to be sold to the rest of the world. It's a productive economy, not a consumer economy like the US or Europe. And then also you pointed out many vulnerabilities within the Chinese financial system, but there's one strength that it has that the West does not have, which is that China has low inflation. China has room to stimulate.
It has low inflation until it is forced to devalue its currency. So I think that's the conundrum, right? Because I think what a strong dollar does is it effectively exports our inflation, and one of the sort of exorbitant privileges of being the global reserve means that most commodities are U.S. dollar denominated. So look. There's all this talk about the Xi visit to Saudi Arabia, how they're going to start settling trades in yuan. There's a big difference between settling oil trade in yuan versus pricing and settling. Trades have settled in non-dollar currencies for a long time, but it has not happened where you've had basically the oil trade get traded and invoiced in and settled in non-dollar currency. I think it's very, very difficult to do. I like to use the and then the other thing is that so she came back with great fanfare saying that his hope is that they're going to do more yuan based oil trade, but as far as I know, I don't think anything has been inked there. And so it's quite interesting, right? All you hear is the fanfare of these visits, and then nobody talks about. Everybody's saying, okay, Saudi Arabia has left the fold of the U.S. and is going to China's sphere. What just happened this morning, Jack? This massive Boeing deal with Saudi Arabia. No one talks about that. Right. So if I'm Mohammed bin Salman, I have to think, okay, do I use the Amazon card, Amazon credit analogy. If I get a refund on a purchase on Amazon, if it's $50, I'm happy to keep it as an Amazon credit, okay? But if it's $5,000, I want my cash back. And so I think from MBS's standpoint, it's very, very similar. Like, okay, if China's a big customer, I want to keep them happy. If I'm going to do like sell a token amount of oil and keep a little bit of Chinese yuan, sure. But I'm not gonna sacrifice my global treasury into a currency that's got a closed capital count and is subject to devaluation.
That makes sense. So there's the hardcore bear case on the dollar, not only on the price level of the dollar against other currencies, but on the usage of the dollar. The dollar standard will fall, and it will fall within a matter of years, and it will give way to the euro replacing it, the yuan replacing it, another IMF Bancor, gold standard, Bitcoin standard, all that stuff. And that narrative, yeah, I think it has a lot of challenges. I mean, for example, to have a reserve currency, almost by definition, the country has to run a deficit. So China runs a surplus, but there's no assets for anyone else. That doesn't make a whole lot of sense. What about the softer dollar case, which is, okay, the dollar standard will remain, the global reserve currency for the near future, mid-future, 10 years, whatever. I'll give that to you, Michael. But Russia, when it has its reserve assets, it's going to buy fewer U.S. denominated assets such as treasuries, and it's going to buy gold instead. China is going to buy fewer U.S. treasuries. It's going to buy gold instead. Japanese investors, they're tired of for so long they've relied on U.S. treasuries. They're going to abandon those as well. What do you think about that softer argument?
That argument has big problems, because at the end of the day, you're not going to spend your gold at the grocery store. You're not going to spend your gold at the market and buy stuff. You need a liquid fiat as your primary medium of exchange, and there simply is no other fiat that comes close to that adoption. I posted in one of my threads this. I think I probably used that tweet in my that chart of my paper. It basically shows the global share of FX reserves of all the major currencies. And would you believe? So there's all this talk about de-dollarization and the U.S. losing share. Well, guess what? The U.S. share of FX reserves has been at essentially 60% since 1995. Oh, what happened in 1999? The euro came along. What happened? Oh, if you look over time, it's fluctuated a little bit, right? But the U.S. dollar share has stayed remarkably stable, and it's actually the euro, and the euro is the most successful competitor to the U.S. dollar to date as a challenger, and the euro is the one that's actually lost share. So as we write in our paper, I think ultimately this notion of Bretton Woods as some sort of Trojan horse that got the world addicted to dollars, and then got rug pulled with the Nixon shock by abandoning gold convertibility in 1971. I think that's a flawed argument, because if you look at what happened long before then, in the 1950s, you already saw this rise of the Eurodollar banking system. And it was primarily because, again, the UK, in its own domestic inflation battle, unfortunately chose the wrong path. They adopted capital controls. And so at that time, and also, look, the UK was heavily indebted after World War II, right? So I think world businesses needed a liquid reserve alternative. And so I don't buy into this notion that everybody is forced to use the dollar. If anything, right? One thing that we point out in our paper is that we don't advocate this continued use, this heavy-handed use of financial sanctions. When most people talk about the U.S. weaponizing the dollar, they're talking about what we did to Russia, right?
Yes.
And seizing reserves and things like that. We don't advocate that in our paper. We're saying that we need to do less of that because that does encourage an active search for alternatives. Why do that? To borrow this framework that Mike Green and I were riffing on in a space, it's kind of like saying, look, we have really what we should be doing is we should be saying we want everybody to play ball in our sports facility. We want to make sure that we have the best, most well-kept sports facility, meaning system of governance, liquidity, depth of bond market, rule of law, which I said, and what makes that sports facility less attractive, of course, is this heavy-handed use of financial sanctions. So maybe do less of that, right? But what the other part of our paper was saying that there are other ways to employ geopolitical leverage, and one way is to literally kill two birds with one stone. We have a domestic inflation problem, which means that we need to stay higher for longer. And it just so happens that the U.S. economy is much more resilient at this point in time, especially vis-a-vis our biggest geopolitical rival. So encourage the world to continue to play in our court. But by the way, our players, to use this analogy, are stronger. Our economy is stronger. So let's use that heavier ball, the U.S. dollar wrecking ball.
Right. So there's very compelling arguments, Michael. And I also say, even if you're wrong, and even if the people saying that the dollar standard will fall, it probably is going to fall in 10 years. It's such a slow moving thing that to make a short-term investment decision on this thesis on your side or on the other side is just horrible. Do you agree?
Agreed. 100% agreed. I think this is a process that occurs in decades, if at all, right? But the way I see the world going, and I agree with Brent Johnson on this. I see first let's not conflate adoption to price, okay? Because in our paper we actually broke this out in a matrix, right? I talk about this matrix of adoption versus price, right? So there you have certain currencies that are relatively widely adopted, but are relatively weak. So I would count, for instance, like the yen and the euro into those categories, right? You have currencies that are not very widely adopted, but are relatively strong, like the Swiss franc, right? Then of course you have emerging market type currency that are not widely adopted and also weak. That's not a great place to be. But then you've got this quadrant 4, which is the US dollar, where you've got overwhelming adoption, and we're at a point in the macroeconomic cycle where it's likely that the US dollar will be stronger for longer, and that's my opinion. And so when you do have that confluence of high adoption and high strength, that's when it does have the potential to be kind of a wrecking ball. It's a complicated macro picture that we live in, because that obviously has negative feedback loops. But my point is that the U.S. economy is better equipped than most of the world to handle those negative feedback loops. We don't rely on exports. We are naturally long natural resources that are denominated in our home currency. Right.
So everything we said is true, but you could spin it either way. We're not relying on exports. That's a strength. You could also say, yeah, well, that means that we consume more than we produce. So we every year have a deficit. We produce debt, and ultimately those claims, are going to be called upon. And as interest rates rise, the debt isn't sustainable. I know we've been going a long time, but just real quick. At what point do you think the debt becomes unsustainable? Because presumably there is a point. It's been far, longer than the people who said the dollar's not going to last in 2011, 2012 when we started QE, or not that's when we started QE. But what is the point? Because we have seen that chart of the interest expense explode higher as the Federal Reserve has hiked. Yes, that phenomenon has not stopped the Federal Reserve from hiking, but it does play into those dynamics.
I think we have a lot longer than what most people think. There's a very interesting book by, I think his name is Richard Duncan. And Mike Green actually interviewed him on a Twitter space where he it's interesting. I don't agree with everything that he's saying, but where I agree with him is the thesis that when you are the world's global reserve, right? The fact that you run persistent trade deficits, that's a feature and not a bug. That's part of it, because you are by definition absorbing surplus from other countries, right? Now, his point is that if that is let's just take that as gospel. If that is the case, let's adopt focused industrial policy and spend that money appropriately. So he's actually advocating, for instance, expanding our deficit by the tune of 10 trillion, but on focused industrial policy, industrial spending. Interesting concept. But look, when you look at Japan, that is in far worse shape from a geopolitical, demographic, natural resource dependency standpoint, and you look at what they've done with their sovereign balance sheet, I'm not saying that we should do that, but I'm saying that it kind of shows you that the trust in a currency system goes far beyond pure debt to GDP metrics. The whole focus of the first third of our paper is exactly to this point, is that it's a big mistake, I think, to just ascribe debt to GDP metrics as, this is what's holding together the world's trust in a currency. And what our paper talks about is trust ultimately comes down to national power, different components of national power. And we focus on three economic pillars of national power, meaning being geography, natural resources, and industrial capacity. So,
thanks, Michael. It's been great getting your view on the dollar, why the dollar is here to stay. I'll actually be talking to Lynn Alden later in this week, so I'm going to get the opposite view. So it'll be fun to sort of hear both sides of it. So, Michael, just you on Twitter are fantastic, and you're at Urban Cowboy. Cow spells your last name K-A-O, and you've got a Substack, Cowboy Musings, again K-K-A-O.
So yeah, it's also urbancowboy.substack.com. Yeah.
Urbancowboy.substack.com. Thank you so much. And so could you wrap a bow on the idea that the bailouts for the help that the government provided to the banks is going to produce financial stability, likely prevent, a systemic banking crisis. And as a result, the Federal Reserve will hike higher. Because that's, I think, that your general thesis of this interview.
Yeah, look, I don't know how much higher they will hike. But I do think that the general path of tightening remains, because I go back to my point that weighing the needs of the many versus the few, right? And I think that inflation being the most regressive tax of all, that impacts 100% of the population, they're going to think about that first and foremost. I think the risk reward is very, very asymmetrically bad if they ease prematurely. just don't see them. And none of the data is giving them cover to do that. Now, I think there will come a point in time when the real trade-off comes. But for now, this BTFP facility, I think, has basically, they've learned some lessons, right, in terms of producing a consistent response, as we opened the hour with. And I think that's ring-fenced the damage. This is nowhere close to a GFC situation, and especially when you consider the backdrop of structural inflation. So I think I am definitely in the higher for longer camp. I await this yield curve to kind of breathe a little bit after some of this banking angst dies down. But we'll see.
We will see. Michael Cao, thank you so much. And thank you everyone for watching.
Thanks, Jack.
Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined. Also, you can get 10% off to Permissionless 2023 and Blockworks Research using code GUIDANCE10. Thanks again, and be well.